This is Trepp Wire Week in Review for week ending January 22nd. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, Biden's inauguration has been followed by a round of executive orders that included mask mandates, appointment of a White House COVID response team, and a call for an extension of the eviction moratorium through March. On the economic data front, while we saw some positive earnings reports, other data point to a recovery stall. 900,000 filed for jobless claims, home builders' confidence dropped again this month, and retail sales declined for the third month. U.S. COVID deaths are at an all-time high, but cases have dropped since early January. Manus, the president is looking to accelerate the rollout of the vaccine, and he said he wants to vaccinate 100 million people in 100 days, which would be a big feat.
It would be wonderful, to be honest. It's actually not the rate. I don't think that'll be the problem. We're at the point now where for several days we've been vaccinating 1 million people per day. So we're on that pace already. I think the big concern in some areas, it's logistics. It seems like some areas it's a logistical mess, but it's also, can we keep up with the level of supply, right? Can the vaccines continue to flow through the supply chain from Pfizer and Moderna at the same rate that they've been going? And that would be a big concern. If they can, it would be a wonderful accomplishment to see that number. And I think that we'd start to see a meaningful decline in the number of cases, the number of hospitalizations, and the number of deaths, which would be wonderful. But I'll take a quick meandering just to start, which is kind of my MO lately, hasn't it been? Really hijack the podcast right from the get-go. I was in the vaccine world this week trying to get my 89-year-old dad vaccinated. So I'm really firsthand at it. I have relatives in New York and myself, I'm in now Western South Carolina with my dad with me. The differences are extraordinary for my family up north from me. Up north, it reminds me of those days when I was 17 and I really wanted those concert tickets or those ball game tickets. And the only way to get it was to camp out at the Broadway Mall in Hicksville, New York, or to set up a bank of phones with all your friends to dial the Ticketmaster over and over and over again. And the night before, you and your 8 buddies would sit down and you'd game it out. First, you'd have to make sure that you all had your parents' credit cards because you didn't have your own financing vehicle at the time. Then you had to figure out who could sneak out of the house to actually camp out at the mall, whose parents wouldn't notice if they left with the car at 2 a.m. And then you try to map out which malls and which Ticketmasters might have tickets. And then you start making a million calls. And then your buddy would call you at 10 a.m. saying, I can get tickets behind the stage. No, you moron. We don't want to be behind the stage. We want to be on the side of the stage. And so this would go. And that's what it felt like in New York, where I had sisters and cousins and uncles saying, you know, can you get me into the Armory in northern Manhattan? I hear they got excess supply there. Well, do you want to be behind the stage with the shady doctor, or do you want to be in front of the stage with the nurse? And it was just like comical this whole week. But down here in South Carolina, it is incredibly efficient. You know, the place we went to today was an empty Kmart. The place had been completely cleared out. Kmart was gone, years ago. They were vaccinating 500 people per hour. The wait was no longer than 20 minutes. They were taking walk-ins. And, you were out. And it was wonderful. My dad got in. Every 6 feet, there was a chair for him to sit in. The people were kind. They watched over him when it was all over, make sure he didn't get any reaction to it. And then at the end, he was rubbing his hands together. He thought he should get like a little reward. So he got to go to Bojangles, for the bacon, egg, and cheese biscuit to just cap it all off. He felt like he had done a good deed for the day. And he got to ignore his cholesterol and his blood sugar for 15 minutes.
He got his sticker and a lollipop. I think if they can get to 100 million, we're going to be in great shape because, I don't know demographics off the top of my head, but there are plenty of people in that other 300 million who are at much less risk of having complications due to COVID. So if we can really target the people that we need to target and get that done, I can't wait. I can't wait to get out into the real world again.
This was so life affirming today. I have to say, after hearing the horror stories of the Northeast and the running out of vaccines, I've had examples of people getting canceled, right? They thought they had a February date and then the state called them back and said, we have to reschedule you for April. It was so life affirming to see, here it was 100 Clemson nursing school students working on the injections with oversight from professional nurses. The paperwork was all there. The efficiency was there. And it really made me feel like, we're going to win this thing. If we can keep pulling this off, like we did today, in 30 days or 60 days, we're going to start seeing real progress. So that was wonderful.
Well, Biden announced 2 appointments this week, Gary Gensler as the head of the SEC and Rohit Chopra as the head of the Consumer Financial Protection Bureau. And some analysts say that means we're going to see some tougher policies aimed at the financial services industry.
Yeah, I think for now, or at least up till this week, financials were really flying high, right? They had seen a huge run up in their stock prices over the last 90 days. Part of that was the hope that a steeper yield curve would allow them to really see better earnings going forward. You'd see them really take off. We really saw each and every one of the financials kind of sell off a little bit this week, even if they beat on the top and bottom line. JP Morgan being one of them, Goldman Sachs, even though they really exceeded expectations, they didn't really take off because I think the expectations were so high to begin with that a lot of the positive news was baked in. But one thing that people haven't really been focused on is the threat of the heavy hand, right? The threat of more regulation, new stress tests, rebuilding their models. We really lived through this in spades when we were building our default model, building our CECL model, building our Dodd-Frank stress testing scenarios and forecasts and capital ratios predictions and so forth. Hopefully the government gets this right, which is, you keep an eye on it, you keep a light touch, you keep looking at efficiency ratios and capital levels and buybacks and dividends, make sure that the banks are not taking excessive risk, but you don't really go with the heavy hand. And I think that would be the sweet spot, a slightly steeper yield curve, but not crazy, where they're taking huge mark-to-market losses.
I think even more importantly, we had Janet Yellen come out and speak, and there were plenty of pundits on the sidelines pumping their fists a ton, because it was just the control P crowd, print money, print money, print money crowd. So we're going to get $2 trillion in stimulus, and then we'll probably get some more after that.
Well, we're recording this on Thursday, January 21st. So Janet Yellen spoke yesterday. You're right, Joe, the markets really took off on her enthusiasm for that. I think they also took off on the peaceful transition of power yesterday, that there wasn't any of the protests that some people had been worried about. That was wonderful. Today's headline, which led to a little bit of a pullback, was Biden is going to have a tough time pulling a $2 trillion number across the finish line, right? That $1 trillion might be more, right, in line.
What world are we living in, Manus?
Right.
Right? I'll digress for a second, but it's right on this topic. If any of you, I'm sure a lot of you out there read a guy named Morgan Housel. He's a financial writer. He writes a lot about behavioral finance. He's got a blog, written a bunch of books, and he came out with a really good blog post maybe a week or two ago. And he had a line in there. It's about a lot of different things, but he had a line in there about how in 2009, President Obama said, I want to do a $1 trillion stimulus, and his chief of staff laughed him out of the room. And now we've done a 2 trillion and almost 1 trillion. And now we're talking about doing another 2 trillion. And the market is selling off on the idea that we're not going to do 2 trillion. I mean, it's like we're living in a whole nother world.
We're living in a whole nother world on so many levels, on so many things, on the political front, on the economic front. Really, there's no end to what 2020 has done to us. So the surprises, I think, will continue. If I had one wish for this stimulus, and it has been a gripe of mine, I kind of talked about it last week a little bit, the lack of creativity among our leaders, the lack of empathy in some ways, the lack of targeted relief, that in this next package, I would love to see the blunt instrument thrown away, right? And by blunt instrument, I think that if you're going to have student debt relief, it should be really for people under a certain threshold of income, right? And I know that that's what they're talking about. I hope they stick to that if they go through with the student loan debt dismissal. I think on the eviction moratorium, right, there should be an employment and an income level for that, right? I don't think that people should be able to free ride if they're still employed and their income is above a certain level. I think that that is true with the SALT tax, right? If you want to lift that level from $10,000, or if you want to get away from it, or if you want to write $2,000 checks, right? I think the threshold should be low, right? It should be under $75,000, and it should be for people that are unemployed, so that if you have to go back to the well over and over again, there's more ammunition to keep, restaurant owners, waitresses, baristas, waiters, people that work in, the movie and concert business, hall business, right? You could take care of them more than those that don't need it. And that would be my wish for whatever they come out with, something less blunt than we've seen in the past.
It's all about the implementation, Manus. Like, I don't think it's the problem is you can put $2 trillion aside, and then you can kind of dole it out, but then you dole it out to a state government, a local government, a whatever agency, blah, blah, blah. And that's where I think actually the direct checks is actually probably one of the best stimulus plans if you can kind of direct it in the right way, because you don't have that middleman of the government, which then delays things or, doesn't allocate it correctly or whatever. Like, there's people are trying to do their best, but the simpler you can keep these things, I think the better.
Yeah, I think so. But with the simplicity, I think that sometimes you under-help those that need the most help, and you over-help those that probably don't need it. And that would include me, right? I've been employed throughout the pandemic. I don't need
You ain't
my
getting
SALT
no
deduction.
stimulus, bro.
Well,
Good for you. So, Joe, we saw, as Manus mentioned earlier, the bank earnings reports in the past week, and it did give us some indication of what's happening in the broader economy. And there were some promising signs.
Yeah, so I have a lot here, so I hope I don't bore you too much. But I went through, the big five or the big six here, and the theme was there were a couple of themes that cut across all of them. One was that consumer lending. If you're heavy into consumer lending, you probably didn't have a gangbusters quarter or year. You didn't get killed, but your net interest margins were compressed. And here's another thing that was mentioned in that Morgan Housel piece, which was actually mentioned in a lot of these earnings reports, is that deposits were up significantly. Based on that Morgan Housel piece, on aggregate at the beginning of this year, consumers had $800 billion in checking accounts, and now we're up to 2 trillion. So the amount of consumer dry powder on the sidelines is unbelievable. But the problem for a bank is that deposits are liabilities for them, right? And if there's not enough demand for loans on the other side of that equation, then they get squeezed because they have to pay, even though they pay almost zero, they still have to pay something on those deposits. And especially if they're not able to put them to work as much as they wish to, right? So loan growth for most of these banks was kind of flat or negative. So I'll kind of run through the list here. So JP Morgan, everyone had, or most of them had gangbuster quarters, some of it due to releasing reserves. So, in bank land, you have to reserve against future potential losses. And that when you change the level of reserves, it either hits your earnings or it helps your earnings. So when the reserves are decreased, you're essentially releasing cash to go to the income statement. So their earnings per share were up 42%. They released $2.9 billion in reserves. So that tells you that they think both the future macroeconomically is more positive than it was before, and also that their underlying loans and the underlying loan performance is actually better than it was last quarter. They had a record revenue year. Their commercial and investment bank profits were up 82% in Q4. So I won't go through all this level of detail for all of them, but the idea was investment banking, where you're underwriting IPOs, you're underwriting new corporate bond issuances, you're lending to corporations. Everybody knocked it out of the park there. Goldman Sachs had an amazing quarter mostly due to that, and they're trading at the same time, right? So trading in this volatile time, all the banks, their trading revenues were up significantly. So on the other side of the spectrum, you have guys like Bank of America and Wells Fargo. So Bank of America was down, their earnings were down 22% year over year, although they beat expectations. Big drops due to low interest rates. Their net interest income is down 16%. And this one is where I saw it. Their deposits grew by 25%. One of the biggest banks in the world, for your deposits to grow by 25%, that's an unbelievable number. Bully for the economy once we get to actually start spending it, right?
It goes back to my original point that for people that are putting money into a savings account or a checking account, right, you've basically written a check to somebody who's probably still employed. And it goes back to the indiscriminate way that this is being handled, right? And, you know, I look at the Federal Reserve and the stimulus packages and so forth. It's like chicken wings, right? Putting more barbecue sauce on a chicken wing that already has barbecue sauce doesn't make it hotter. It just makes it soggy. But the ones that don't have any barbecue sauce, you want to put on barbecue sauce, right? You don't want to be eating a dry chicken wing with no sauce. And right now, we're just throwing sauce everywhere. We're ending up with a lot of soggy, soggy checking accounts.
Call me a soggy chicken wing. So a couple more notes here. So one of the more interesting ones was Morgan Stanley. So they had a great quarter. They were up 51% year over year in the Q4. Their revenue was up 26%, trading up 32%, investment bank up 46%, mostly due to what they were saying, $1 billion in IPO underwriting fees. And now, interestingly, their wealth management division was up 24%. These same divisions in the other banks weren't really up at all, or maybe up a little bit, down a little bit here or there. But a lot of this was due to the fact that they acquired E-Trade in the fourth quarter. So, and E-Trade is, the Robin Hood of 10 years ago. And there's a lot of people on there trading. They had, I think it was something like in their retail accounts, they were executing something like 1.1 million trades per day, which was the highest ever for them, which is huge. And they said that E-Trade users on average are 10 years younger than Morgan Stanley wealth management clients. So I was thinking, when are we going to see JP Morgan or Goldman Sachs buy Robinhood, right? Because you have these kind of low cost, easy to use trading apps that are getting all the younger people who have a little bit of money to invest onto them, and all these older, staid banking institutions that are trying to get access to those customers. So I wouldn't be surprised to see a few more of those type of acquisitions. And Citi and Wells Fargo. Citi was kind of like the black sheep of the whole family here. Didn't have a great quarter. Wells Fargo was just kind of flat. They had a decent year. There was one quote from their CFO, or it might have been their CEO. Although our customers seem to be in better shape than we would have forecasted, the accommodations that we've provided since the start of the pandemic are also helping to delay the recognition of charge-offs. I would put that sentence across the whole economy, the whole lending economy right now, including commercial real estate. So there's a lot going on under the covers of forbearance and deferrals and things like that are coming to the fore or will come to the fore this year.
So let me give a quick programming note. I'll interrupt for just a second. We are co-sponsoring a webcast next week with Eisner Amper. Joe Rubin, who I go back with a really long time, is hosting this. There are speakers from Wells Fargo, Bayside Capital, Proskauer, who is also a co-sponsor, and Trepp. And we're going to be talking a lot about this, which is the opaqueness of bank delinquencies over the last year. That will be one of the topics that Joe Rubin brings up, that you don't really have a great sense of what they're going through right now because of their pushing off of these issues for the time being, right? We have great transparency in CMBS in that data, and we talk about that all the time. And that will be a topic next week. But you don't have that with banks, and the people at Wells Fargo will talk about that a little bit next week. If you want the link for that, just email us at podcast@trepp.com, and we'll send it over to you if you want to take a listen to that.
And staying on bank performance, we released new data that showed that there's a rise in Q4 delinquency rates.
Yeah, so as of yesterday, I think it was, according to data for banks that have so far submitted call reports for Q4, so that's not every bank in the world, but it's a good sampling. Delinquency rates or non-current loan rates, they started Q4 2019 at around 55 basis points or so. We're up to above 120 basis points now, which is an increase of about 20 basis points quarter over quarter. Now I'm looking at the chart here, so I might not be exactly right with these numbers, but that's to the general gist. We saw kind of a hockey stick there on non-current loan rates. Now, kind of diving into our loan level, that was call report data, which is high level, kind of aggregate level data for banks. Looking at our loan level data that we get from a consortium of bank lenders, I think we talked about this already in the last couple of weeks, but office, multifamily, and industrial delinquency rates have stayed relatively flat in these bank lending loans, whereas retail and lodging, retail's actually higher than lodging. Retail's up over 5% and lodging's just under 4%. So these numbers don't sound that high when we think of like in terms of CMBS land, because in CMBS land, we're at like 20% for lodging and I forget, 15% in retail, something like that. But these are really high numbers for banks. And I think that Manus said it, right? The actual, if we called it like the shadow delinquency or the underlying distress percentage in these banks is probably significantly higher.
Turning to multifamily, the Biden administration wants to include both rental assistance and an extension of the eviction moratorium to buy time for a recovery. Is that going to be enough for some of these urban centers that we've seen with a migration of people moving out?
We talked maybe a month and a half ago, we had put out a research piece talking about how there are about 50 loans, maybe it was $5 billion or so in total, that had started to show small cracks in their occupancy levels. And we wondered if this was the canary in the coal mine, if you will, of private label CMBS multifamily starting to fray. I don't want to call it unravel. What we've seen in hotels and retail, that's an unraveling, right? I don't expect an unraveling in multifamily, but were we going to start seeing some fraying there? And the answer is, to some degree, yes. We saw several stories this week, some of which we've already covered in Trepp Wire, some that will be forthcoming, I guess, tomorrow or Monday, but they were concerning. So let me start with one we put out yesterday. This was a $481 million portfolio. It's called the MFP portfolio. Unlike other stories we've been concerned about, which were largely focused on 24-hour cities like San Francisco and New York, this portfolio is 43 apartment complexes spread across the Midwest, Southeast, and Southwest. It had a 1.42x DSCR and 86% occupancy in 2019 when it was securitized. For H1 2020, DSCR fell to 1.02x, so still above water, but significant decline. Occupancy down to 75%. For Q3 2020, I think this is a trailing 12-month number, 0.86x for Q3, 76% occupancy. So now underwater. And the note included this. The servicer watch list note had this to say, and this is from the borrower. As a result of the COVID eviction moratorium and tenants not paying rent, physical occupancy is now exceeding economic occupancy. So if you're going to look for a canary in the coal mine, this is kind of it, right? Big portfolio spread across, in some cases, Sun Belt markets who had thought to be the overperformers in this market. All of a sudden, we're seeing a fairly sizable occupancy drop, and DSCR, which is below water. So this is a loan which backs a single asset 2019 deal. And for listeners of the podcast, if you want to ping us, we'll send you this story. It's really intended just for our clients, but as a freebie, we'll throw it out there to you. Two other stories I'll touch upon. These are more in line with what we had talked about in the past, right? New York-centric concerns, people fleeing New York City to probably just save on their rent. The Link, LINC, that's the name of the loan and the complex. It's a 715 unit apartment complex in Long Island City, not far from where Amazon was going to build HQ2, which was later kiboshed by New York's mayor and other leaders for not being generous enough, I guess, or too demanding in the tax abatement side. So Amazon went to Virginia. This is a nearly $200 million senior loan. The property is loaded up with lots and lots of B-note debt as well. So listen to this, 97% occupancy in 2018, was showing a little bit of a dip in 2019, down to 91%. As of Q3 2020, 67% occupancy. So 30 points of downturn over the last 2 years. And just to give this some perspective, Joe and I are native New Yorkers, or at least I was for a long time. To give you a perspective of what people pay in rent in New York, it's not unusual for somebody to pay $3,000 or $3,500 in rent per month. And in addition to that, if you have a car, forget about it. The insurance and the parking will run you another $2,000 a month. And you also pay 4% income tax just to New York City. So if you're somebody who's 25 and you're moving home, you're really talking about pocketing after-tax dollars of maybe $40 or $50 or $60,000. And it's kind of a no-brainer. So when Joe talks about Bank of America's checking account numbers going through the roof, that has to be part of it. The last property, 221 West 29th Street near Madison Square Garden, Penn Station, 96% occupancy and a 1.30x in 2019, 71% occupancy in Q3 2020, DSCR under 1.0x. So the cracks are starting, and if this moratorium continues through March and then it gets extended to June and then to October, you're going to see more of this for the private label stuff.
Turning to hotels, reports published this week say that we may be looking at the start of a wave of hotel bankruptcies.
Yeah, we saw one today that was kind of interesting. Eagle Hospitality declared bankruptcy. Their niche is all over. They have operations in many major cities across the U.S. I think they operate 26 hotels. The most noteworthy or the most interesting from a Jeopardy point of view is that they operate the Queen Mary off Long Beach in California. So the former luxury cruise liner was turned into a hotel a couple of years ago.
Talk about a double whammy in COVID times, huh?
That's right.
Your hotel and your cruise ship.
Right. So they don't leave, though. They stay in port
but still.
The whole time. But that's, one of their big operations, one of their big properties that they run. They declared bankruptcy today. So we'll see what happens there. We did update recently. If people remember, we created a deed-in-lieu website on our core product, our webpage, our web product, which has all the properties for which the borrower has signaled that they're ready to throw back the keys. We added another 10 to 20 names this week, as has been the case throughout the pandemic. 60 to 70 to 80% of the new names continue to be hotels. So 90% in total are either hotel or retail. And, we're just seeing an acceleration of the number of borrowers giving back the keys.
Yeah, the number on that now is 127 loans, 4.5 billion outstanding right now.
So, a lot of these are, sometimes these things are very fluid. They think they may give it back. They have a change of heart. They come up with an agreement. There's an extension, a modification. These are all the ones for which we've parsed out watch list or special servicer notes that have indicated that the borrower is ready to cry uncle.
A lot of malls on here too, just by
Yeah.
looking at the names.
As of today, actually, the New York Health and Hospital reports that approximately 8,000 New Yorkers are safely self-isolating in hotels citywide in New York, and that by February, that number could reach 10,000.
And that's a freebie, right? The city of New York is picking that tab up.
They are picking the tab up, and you get Wi-Fi and meals and
It sounds like an
privacy.
unbelievable vacation. Can
Is
I
it like
just go
Priceline?
quarantine?
Remember with Priceline back in the day?
Name your price.
Name your price, but not only could you name your price, but you could name your quality of hotel, right? I want to pay $90 and I want a 4-star hotel.
And William Shatner will meet you at the door.
He'll take your bags up to your room. Normally, that type of thing, like you'd get shut out. If you wanted the 4-star hotel for $90, you weren't getting bupkis. Like you'd have to up the bid to maybe 175 or something. But if you were willing to, do bed bugs and,
The rat crawling across your back.
maybe, you could do $45.
So as someone with a 1-month-old child that wakes up several times throughout the night, and also a 2-year-old that by accident on purpose slaps you in the face 3 times a day, I think I might be down for a 10-day quarantine at a hotel for free at this point.
I don't think
Bed bugs or no.
I don't think you qualify, Joe.
Well, it's self-qualification, isn't it? I mean,
no, you have to call and explain that you've been in contact with someone who's tested positive or
oh,
you
that's
have
very
tested
easy.
positive. Yeah. And then they
So
will
if you,
put you on the list.
if you want, tips on how to getting the vaccine, get it on the short list in New York, give me a call. I'll give you the tricks I've heard from my relatives. If you want to get into a hotel for free, Joe's your man.
Have there been articles about this yet? Like vaccine tourism? I think there were, like people flying down to Florida to get the vaccine. Like, Manis, you should start a little Airbnb enterprise down there. $2,000, come stay for 2 nights, play around a golf and get the vaccine.
That's right.
Awful.
You can,
Awful.
well, I mean, that's really, my father's a native New Yorker, but, a while back, just because down here it's more sparse. He
Yes.
said, I'd rather be down there. The weather's warmer. You can play golf. If you choose to go out to dinner, there's just not that many people around. But it also worked out for him that, he got the jab in no time. So,
Well, not all states have expanded the pool of people that are eligible to get the vaccine. I think only about 28 now allow people older than 75 to get it, not just healthcare workers. So it could just be a factor of what the state is and how large their population is. In office news, we saw some news about some assets being resolved with a big loss.
yeah, this was a disappointing story. We talked about last week that 2 Westlake in Houston had been sold to Union Properties, which we thought was great. We thought it was a terrific sign that, there is a bid for Houston properties, hotel, office properties. But at the time, we didn't have the price for this. So the property backed an $87 million loan. It was part of a CMBX 8 deal. The property had been valued for $124 million in 2014. Prior to the sale, there had been a third-party valuation of $24 million. So we were knocking wood last week that the sale would come in 35 million, 40 million, 50 million, something that, this is great. The loan was liquidated this week with a $71.7 million loss, liquidation proceeds of only 18.1 million. So, basically 1/7 of the value from a couple of years ago. If you remember from last week, we said that the property was only 6% occupied. BP, Federal Credit Union, and ConocoPhillips had a lot of the space, both vacated. So an $18.1 million gross proceeds upon resolution, that might even be higher than what Union got it for, because sometimes that liquidation price proceeds includes liquidation of reserves that have been sitting around, unused proceeds. So we'll get a final number at some point out of this, but it's going to be in that $15 to $20 million range, which
Would you say was the original value?
$124 million in 2014, $87 million loan, $72 million loss.
So it's like 15% of.
Yeah. I mean, it's the
Right.
kind of number you expect these days from a liquidation of a mall that was securitized in
Right.
2012. You don't want to see it in any kind of office. You know, if you're going to see it, it's going to be in the Houston office because that's a problem.
Yeah.
With oversupply and a lot of energy problems. But this is a disappointment at any level.
This is ripe for one of those stories though you hear though, like in 2 or 3 years. Like I always think of like Taconic Capital, like they're really active in this space and they'll like pick up a property like this. And then 3 years later, they will have re-tenanted it and put a new facade in and a new lobby and they'll sell it for $110 million. Right.
They may have somebody in their back pocket that's going to take 40% of this. And then they come out in a couple of years and get a $40 million loan off this.
Right.
You know,
Right.
and I hope it
It's
happens for them.
It's the
right?
circle of life.
Smart money is smart money. And if they can turn this like Appaloosa did buying
Right.
AJs and AMs 10 years ago, you know, good for them.
And looking at deals of the week.
Yeah, I got a couple of them. They're all of the same ilk. I was a little bit lacking in my creativity this week. I spent a lot of time, not a lot of time, it was very quick, but just getting that vaccine. So I was a little bit less focused this week. I was also listening to the CREFC conference, which continues for one day tomorrow, which is very interesting. Shopping center business had this one, the Mainover Shopping Center in Vinland, New Jersey, 140,000 square foot grocery anchored property sold for 13.1 million. The seller was a private investor anchored by an Acme supermarket. Marcus and Millichap repped the seller. Cody Traver, Joe French Jr., Thomas Delzell, and Mark Taylor of Marcus and Millichap repped that deal. This one, according to Tucson.com, Midstar Plaza sold for $5.5 million, a retail/office property. The seller was private. The buyer was a San Diego investor, LBM Investors. They were repped by Zeal Property. Maha O'Day Arnold represented Zeal. Nancy McClure, Philip Voorhees, Jimmy Slusher, Sean Heitzler of CBRE repped the seller. What I liked about this one was here the tenants was not a grocery anchored, right? It had the kind of places that you would expect to struggle in a pandemic. Opa's Best, which I think is a restaurant, Polish kitchen, and CI Choose Mongolian barbecue. So it's the kind of place that you think might have suffered during a pandemic, yet here they go and they get this property sold. So good for both of them.
And shout outs. Our favorite Steel City Dave gave us a shout out for last week's education segment on multipliers and valuation. And Brian B., who's a repeat shout out, asked us a couple of questions. One, he referenced the Cushman Wakefield story that cited that in San Francisco, millions of square feet have piled up for sublease during the pandemic. And he was looking for some information as to whether that was a trend in some other cities.
I think the answer is yes. And there's more to come on that because I think we're going to do some more work with Comstack to do some analysis on sublease availability in these lockdown cities. But I have to think that the answer is yes.
Stay tuned. We'll release that and let you know. Mark T. appreciated the candor on all our topics in the podcast and very much appreciated the level of detail explaining drops in valuation on distressed loans per product type. And he loved Manis's castor oil metaphor that he used to describe tactics to address the pandemic and the shutdown.
For people like Mark T, we should release like a director's cut so he can hear what, we say before and after and during the podcast that gets cut out. Then he'll really like our candor.
Oh my.
It's one of those things where you make these like meanderings and you're wondering if there's this segment of your audience that thinks, that guy down in South Carolina, they should send the guys with the white suits and the straight jackets. What's he talking about? Castor oil and other things. So
And chicken wings.
As long as you're
Yeah.
getting some sort of reaction, that's all that matters.
any pub is good pub. Is that what you're saying?
That's right.
Sometimes. And then lastly, Jeff D and Dio on Twitter. We frequently will get a nice shout out on Twitter. He likes our CMBS data and the podcast. Thank you for that positive note.
Oh, and Fort Worth Chris we gave him a shout out on the pod last week because I was reading about
He
his
did give
office
us-
stuff, and then he tweeted us back. He's actually uses Trepp a lot in his day-to-day life, so that's pretty cool.
And next week, we're going to be releasing the delinquency numbers. So tune in next week. As we know, air travel has been a fraction of normal levels. I think it's back down to 500,000 through the TSA checkpoint numbers. And even if you do travel, there's typically no in-flight service. Well, in the category of when life gives you lemons, American Airline has found a way to sell their leftover booze. If you can believe that, you can sign up for a subscription wine service and get a bottle or a case sent to you on a regular basis.
The bottle comes in a little envelope in your mailbox. It's one of those 6-ounces.
So this would explain that, Martha told us before the podcast that she had 12 bottles of wine last night. So that
I
would
was barely buzzed.
that would explain it. It was probably some low quality stuff, but it's
No,
probably
it's the
for
good
a
stuff.
nasty hangover, I suspect.
No, it's the good stuff. It's the good stuff on their transatlantic and international flights. It's not the stuff that, you get on these short hops here.
I want to mention one more thing. I don't know if we're wrapping up yet, but we brought it up last week, but wanted to give a second plug to that Barstool Dave thing, up to $30 million. I'm seeing all these famous people now starting to donate. Tom Brady, the New England Patriots have donated. I can't remember some of the other people, but I saw just this litany of people that are stepping up, and I think it's wonderful. And can we do this? Can we send a Trepp podcast T-shirt that anybody who pings us on Twitter and tells us they donated to Barstool?
We sure
Is that
can.
allowed?
Yeah.
I feel like we're commercial real estate guys. We should be helping the.
It's true, right?
restaurant tenant.
These are all the restaurants that have to pay their rent, right? So
I
in the
didn't
end,
mention that.
it helps it out.
Right. We're helping our own cause. And I love that we're doing that. And I love that they're doing that. So, tweet at us or email us a picture or whatever, and we'll send you out a T-shirt. You know what? Let's go even further. If you do that, I'll throw in another $50 donation for anybody that comes back at us with
Wow, you're
with
feeling
something like that. Can I do that?
very generous.
You can do whatever you want with
You
your
can
money.
donate any money you have, man.
All right, I'm going to do that.
All right.
We may
wow.
put a cap on it. If this gets crazy, my wife, may
You might have some explaining to do.
throttle me. So, but
All right. Well, with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we discuss what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.